you can have good appreciation and good cash flow. Like, it's not either or. I think a lot of people consider that on a spectrum of being, well, this is going to be less cash flow and more appreciation, so I'm going to be focusing on this market, or the opposite. I want to be in an area that cash flow is heavy and I won't get any appreciation. That would be true in like a lot of the Midwestern markets like that we participate in. But the reality is you can have your cake and eat it too, having appreciation and cash flow and buying properties below market value to have immediate equity and maximize all these tax benefits in the right market.
My name is Rodman Schley. As a real estate expert, I've invested millions of dollars in vacation properties all around the world, and I've been involved in the valuation of billions of dollars of properties. I want to share my 35 years of experience along with vacation home investment tips from the top minds in the short-term vacation rental industry. Now, let's do the work. Hey everybody, welcome to the Vacation Property Secrets Podcast. I'm your host, Rodman Schley, and today we're lucky to have an industry expert who's been featured in Forbes, USA Today, and Inc. 5000. Zach Lemaster is the founder and CEO of Rent to Retirement, the nation's leading turnkey investment company. Zach's a seasoned real estate investor and a licensed broker that has accumulated a large portfolio of rental properties across multiple platforms, including single family, multifamily, commercial, and even new construction. He's passionate about educating others on the numerous benefits of real estate investing and how to use real estate to create generational wealth for their family. Zach, welcome to the show.
Rodman, thanks so much for having me on. I'm excited to be here.
Yeah, I'm excited to have you on here today too. I know that you are somewhat of a, let's call it an analytical nerd when it comes to investing in real estate. And I think that's a good thing. I think people that invest in real estate need to be very analytical. They need to understand the methodologies and the fundamentals behind what they're buying. And unfortunately, a lot of people, especially when you get into the short-term vacation space, they don't look at the fundamentals. They buy it on heart, they buy on emotion. But today I want to talk a lot about what it takes to really dive into the fundamentals and understand markets, understand the different things that are driving value when it comes to real estate. So maybe you could tell a little bit about your background and how you got into the investment space.
Yeah, happy to. And I love the numbers. I think a lot of people, to your point, Robin, about being analytical, you absolutely have to be analytical and try to separate yourself out emotionally, which especially when you're looking at vacation rentals, you can become emotionally attached because there's that's a nice thing about vacation rentals, because you can have that personal attachment to it where possibly you could vacation there, right? And those are like fun properties to own. But I couldn't agree with you more. You got to look at the numbers, but also, I think there's a lot of ways that people can participate in vacation rentals and all real estate where you can have a little bit more control over the numbers and make an investment, make a creative investment work for you that maybe a lot of other people can't because they're not so familiar with the numbers. But yeah, just to tell you a little bit more about our background. So my name's Zach Lemaster, the founder and owner of Rent to Retirement. We're the nation's leading turnkey investment company. We essentially, identify the best markets throughout the country that are based on real estate fundamentals, where, we do a lot of new construction build to rent properties where we sell those to our investors, where we handle everything for them. We lease them, we manage them, we do the market research. Those are mainly long-term rentals, but we do have some short-term stuff. But that's kind of a way for people to diversify and scale their portfolio in different parts of the country. But I actually have a background in healthcare, nothing to do with real estate. I'm an optometrist by education. So is my wife. I met her in school in Oregon. I was commissioned as a captain in the Air Force for 7 years after I left school because I was on scholarship. And and then I moved out here to Colorado. I worked in private practice for a few years before eventually kind of retiring ourselves early on through investing in real estate. But the first house I bought was a duplex. Young captain in the Air Force, lived in half, rented out the other half. That was probably about 14 or 15 years ago at this point. I fell in love with real estate because of that. Love the concept of being able to borrow someone else's money, i.e. the bank, to have an asset that someone else paid the loan off for me, the tenant, and also have all the other things like the cash flow and the appreciation, the tax benefits. But I just fell in love with real estate and continually invested, year after year. So the next year I bought a few more rentals and a few more, and then we started to invest out of state because we saw better opportunity than our own backyard. And that really was a game changer for us and was the foundation for this business. So that's probably about as quick of a story as I can give you.
Well, and I think your story is like a lot of people's story who get into real estate. I think they start somewhere else, or they get into the career world, and all of a sudden they see the opportunities of real estate investing, but it takes a little bit of time to make that transition to really understand the fundamentals or how to buy. So you came from, I mean, you're an optometrist, you're sitting there, you're a military guy, and all of a sudden you're going to bridge this gap to going, like, I'm going to be a real estate investor. And I mean, you probably got some of those base fundamentals of those ideas when you had that first duplex, but how did you really go from being a person who had a base level knowledge on investment to where you're at today? Because that's a big jump to get into that knowledgeable space where you really understand what you're doing as an investor.
Yeah, well, the first thing I'll say is it didn't happen overnight, right? It happened over, many years. I think at some point, it was probably years somewhere between year 5 to 6 or possibly early 7, where we were able to replace our active income as we had good jobs, right? And, but I'll say this, Robin, I never had the intention of like leaving my career path and being a full-time real estate investor. I was not someone who's like, I hate my job, I want to replace it, like, and retire early. I like working. I love helping people see. We still actively, we're still licensed in Colorado, and we do a lot of volunteer work.
Yeah.
But real estate investing was just something that just made sense to me, because you could be, one, sophisticated with your money and be a smart investor. Everyone wants to be a smart investor. You work so hard to earn money, and then you want money to work for you. And I saw that happening in real estate. Also being conscious about like the tax benefits and things like that really helped to catapult in our investing and expedite that. But, at the end of the day, ultimately, I just kept investing. I mentioned earlier, we made the decision after probably 2 or 3 years of investing locally, which I was stationed in Grand Forks, North Dakota at the time, which is not like a highly sought after investment market. We weren't emotionally attached to that area because we knew we were leaving at some point, but, we started to just look at other states where we saw better growth, better appreciation, better cash flow, more affordability, all these things that were, I think, important to, as you start to really understand real estate and, how wealth is created over time. We just started focusing on better markets, but we just kept investing. I never had the intention of like building this business, which we have today. This was just a result of us continually investing in real estate, enjoying that, helping other people do the same thing, and being strategic around where we started to invest. And so we started to invest out of state in some of these more growth areas, a lot of times focusing on new construction. And, to our surprise, because we didn't necessarily anticipate this, but we invested in some areas that like doubled in their price, over a few short years. So that's just was an eye opener for us of like how equity can be built over time. And then we sold those properties and did a 1031 exchange and bought more assets. And then you start to compound things that way. And so really we were just continually investing ourselves, and just never looked back. I always tell people there's not been a single year since I bought that first duplex that we haven't bought real estate. I'm not saying I've made money on all my real estate deals, but we just kept our head down and kept investing. And then we had a lot of friends and family and colleagues that were like, hey, we see the success you're having investing all across the country in these different areas. Like, can you show us how to do that? Can you help us? We don't have the time, the energy, we don't have the knowledge, and that was kind of the birthplace of rent to retirement. But we just kept investing, and always looking at the next opportunity.
So you guys came out, so you're in Colorado now, and you and I both are in Colorado. I love Colorado, by the way. And sometimes the fundamentals out here make sense. Sometimes they don't to me. Just kind of depends on the property type, the asset type we're looking at and such. But how did you get to the point where you went into these markets? Because a lot of people might be thinking, well, he's talking about going into all these different strategic markets in different areas of the country. And I'm assuming that you're in multiple markets. You're not just in, say, this Colorado market. What's the importance to you in terms of diversifying and making sure that you're in multiple high quality markets?
Yeah, I think, a lot of people understand that, diversity is important in investing. And I think they get that concept, right? You don't want to have eggs and all your eggs in one basket in any type of investment. And real estate is no different, whether that's an asset class, geographic, location. I think diversity is really important. But what we found just by networking and learning from more sophisticated, successful investors than us is just that most investors that have achieved some level of success likely have a diversified portfolio across different locations. But the U.S., it's a very dynamic market. We have an extreme shortage of housing. We have a deficit of 7.5 million houses in the U.S. We have an extreme affordability crisis right now. There's a lot of this big population shift in a lot of ways down to the Southeast and the Sun Belt. That's a lot of where we do our build to rent, new construction and development. But we were just conscious of like, hey, there's likely other places that are more conducive to our goals that potentially have better upside than our own backyard. I also love Colorado as well, but we don't do any residential investing here because we just know that we can do better in other markets. Now we do own some short-term rentals here. We have some commercial retail centers here that we like. But when you look at the fundamentals and the analytics, understanding the numbers of real estate deals, like you can buy a $250,000 new construction A-class asset in Texas or Florida or Alabama or Carolinas and some of these Sunbelt areas that is going to produce a 12% cash on cash return using your conventional loan, even with where interest rates are at right now. That it still has double digit appreciation year after year, even right now, even over the past couple of years, and still has rental growth at 6 to 8% per year. So when you just look at that, like depending on the asset class and things you're looking at, it's just being conscious of what markets make sense and where your money is going to work the hardest for you and being opportunistic about that. But when you're first looking at a state, it's like, you don't have all that data, and it can be rather daunting to try to understand all these different markets. And I think that's paralyzing for a lot of people, just not knowing where to start or why they would invest out of state and not having a clear idea of what ultimately their goals and strategy is. But I mean, that's kind of what our company was developed to do, is like, we're doing the market research because of, we were first interested in investing in these different areas and then building the teams and the systems in all these different areas, so we can educate investors about the different locations and then help them easily participate in these markets without having to stand their own team from the ground up or, try to understand the local market. I mean, that's kind of the purpose of what we do today, but it's just consistently being conscious of like, where's the opportunity at?
Yeah, it seems to me too, like these people that you're talking about that are coming into, say, a residential market in Colorado and say you're getting a 2 cap, instead of that 12 cap. But they're banking on the appreciation. So they're saying, you know what, I'm going to buy at this low cap because I know over a 5-year holding period, 10-year holding period, I'm going to be able to make that up on appreciation. But I just don't work that way. For me, it's like, I want the appreciation, but I also want that 12 cap for the brain damage that I'm going to have over that holding period, right? I mean, for me, anything that happens on the side of the appreciation is just bonus. It's just gravy. But a lot of people just invest on the prospect of having good appreciation. And it just doesn't fundamentally make any sense to me why you would forego and even go into some negative cash flow situations if you're getting lending on your property because you think you're going to get a good enough rate of appreciation over the hold. And for me, I always tell people, no, look really strong at your return, especially right now. Look on the cash return. What are you getting on your cash? Then look at what happens if you leverage it out. Does it make any sense, depending on the interest rates, depending on the expenses? And then I always model a 3% appreciation rate. And I don't care if a market's gone at 10% for the last 5 or 10% for the last 10 years. I still go in and go, okay, I'm going to model a 3%. And then if we get 10%, we're all going to have a big party at the end of the holding period.
Yeah, I mean, appreciation speculation ultimately, right? And it's also timing. There's no question that all real estate values go up over time, regardless of short-term fluctuation. But markets can fluctuate, and that's why it's important. Like you said, I think, Rodman, I agree with you 100%. Is you need to be conscious of all those things and make an educated decision, not just focusing on appreciation. Because it's not fun to have a break-even or negative cash flow property for a significant period of time when you're holding out for appreciation. And when you need to refinance or exit that property, I mean, you would hope that the market is good at that point. But that's how people like compare stock investing, right? Hoping that it goes up in value over time. And real estate, there's just so many other variables to control. And the other thing is that you can have good appreciation and good cash flow. Like, it's not either or. I think a lot of people consider that on a spectrum of being, well, this is going to be less cash flow and more appreciation, so I'm going to be focusing on this market, or the opposite. I want to be in an area that cash flow is heavy and I won't get any appreciation. That would be true in like a lot of the Midwestern markets like that we participate in. But the reality is you can have your cake and eat it too, having appreciation and cash flow and buying properties below market value to have immediate equity and maximize all these tax benefits in the right market. You just have to know where that market is.
Yeah. And I hear a lot of people talk a lot about short-term vacation rentals, what's happening right now in the marketplace, and how I hear a lot of people say it's oversaturated. Of course, occupancy has been going down. And the thing that I'm seeing most, though, is that, when we hit COVID it was just a whole different climate where we could travel wherever we wanted to. My kids didn't have to go to school. They were doing everything online. I didn't have to go to any kind of office. I was doing everything online. So you could just get up. And if you wanted to go rent a place, we rented a place in Manhattan Beach, California for 2 months, just went out there, hung out, did our school, did our work, then went and hung out at the beach, in the afternoon. And the thing was that so many people bought vacation homes during that period, but they didn't buy on fundamentals. They just knew things are really good right now. I can get a lot of money in on this thing. And they didn't look at historical occupancy rates. They didn't think about what happens when COVID goes away and things come back to normal levels. So I feel like a lot of people are in struggles now because they're like, I'm not cash flowing like I thought I would cash flow. I'm not able to cover that mortgage, or I'm not able to cash flow this thing and cover what I needed to. So a lot of people are in a situation now where they can either A, get better at being an investor and an owner, or they can B, get rid of their properties. So I'm also seeing a lot of opportunities starting to hit the market because of the people who are just bailing on this investment type.
Yeah, there's opportunity in that, right? Just to, I think, is it Warren Buffett who has a quote or whatever, be greedy when others are fearful and fearful when others are greedy, or however it goes. But yeah, you obviously, we saw a lot of people jump into short-term rentals in COVID because you could, and those are numbers that are not, those are optimistic times and the best times, right? Where you did have a significant performance where, you could buy a property and really almost anywhere and do decent on it. Yeah, but now we're back to reality, and maybe there's some opportunity with those individuals that, we're not looking at, what happens if the occupancy decreases by 20% or the ADRs go down on this significantly. So, the short-term rentals that we buy and bought during COVID and pre-COVID, we've done well because we really focus on a very specific niche that's higher end luxury homes that are very unique, that are specifically in vacation destinations where, we feel confident we'll continue to see high performance. COVID times were great, but they still make sense today, just focusing on all the things in that area that we can outperform our competition. And the simple fact is that there's not a lot of competition too. So I think also being unique in the type of assets, specifically in short-term rentals, like if you're in a lot of this area, so we invest in Summit County, which is up the mountains here in Colorado. That's Breckenridge, Keystone, A-Basin, all those type of areas. Destination for sure, highly regulated. There's a lot of things changing in regulations there. But if you owned, a 3-bed, 2-bath condo that's 1,200 square foot or whatever, you're kind of in this box, right? Where there's so much competition out there, like the market's going to dictate where your rents are at.
Yeah.
So one thing that we've done that has kind of separated us outside of that is that we kind of set our own comps because there's not a lot of other competition out there with the niche type of investments and amenities and things that we try to employ.
Hey, everybody. I hope you're enjoying this episode of the Vacation Property Secrets podcast. I want to let you know about one question that I get all the time, and that's, how do I forecast my cash flow and my profitability when investing in a vacation home? Now, if you've ever wondered that, or you know somebody who has, you're in the right place. We've created a free training called Financial Forecasting for Maximum Vacation Home Profitability. Now, in this training, we're going to guide you step by step on how to accurately project rental income, estimate your operating expenses, and calculate your returns so you can make informed investment decisions. You can access the free training at vacationpropertysecrets.com. So if you're ready to dive deeper into financial fundamentals and maximize your profitability, visit vacationpropertysecrets.com. Now, and that's interesting. And I do think a lot of people, especially you talked a little bit about outperforming the market. So, and I always tell that to people, it's like, you can look at market statistics, but there are going to be people who are going to be exceptional in what they're doing in this space. And you've got a choice. You can either number one, come in as an unsophisticated investor, not understand the analytics, not understand the fundamentals, not understand anything. A lot of those people came in during COVID. There are the people who are performing in the market who are just, they've got the basic fundamentals. They understand, what they're doing. But then there are people that are really going to be exceptional and go out and figure out how to outperform. And it doesn't take much, I don't believe, to get from that middle ground to outperforming. You just got to put in a little bit of that extra work to really understand what's going to move your tenants into your space. How can you set up your property to be more appealing than what's in the marketplace? But it's more about, so many people get up and think they can just, put a sign up saying I'm in business now and I'm going to do exceptionally well, but that's just not the case. There are people all along the spectrum, and the people who are really doing good in the space become professional. They understand exactly what it's going to take to outperform the people who don't put in the work.
This is a business. You need to approach it like a business, and that means all of those things, paying attention to that. I mean, pictures, the little things matter. One thing that we found is like just, and I think this is a direction a lot of like the listing sites are going in their algorithms, at least with Airbnb and Vrbo, is just experiential travel and looking at unique things that are separating you outside of the norm, right? And all those things really matter. One example is we do like what we call lifestyle shoots. And so instead of just throwing, and it's a few $1,000s to do up front, tax write-off because business expense, because this is our business. But, we actually bring in actors and have them stay at the house for, a couple of days and take experiential shots of them. So the guests can visualize them and their families, using that house. We show pictures of the amenities, the things that they can do. So we're creating this vision of, this is not just a house and here's the layout of the house, right? So many people take iPhone pictures and throw their listing up online. It's like, we're trying to help the guests visualize not only what they're going to be doing in the house, but in that general area, right? And really leaning into those amenities. And that's made a huge difference.
When you're looking at markets, when you're identifying markets, and I do a lot of this, I enjoy it. I've got my points when I'm going into a market, things that I'm specifically looking for analytically or analytical. Is that saying that right? From a very analytical standpoint, to try to figure out, is this market going to be a good market? Do I think it's going to perform? Sometimes that proves to be wrong. I mean, sometimes you might go into a market and you might find out, I looked at all the analytics and maybe it just isn't going to perform like I thought it would. But what kind of things do you look at specifically when you're going into a market?
So this is on the rent to retirement side. What I was talking about on the short-term rentals, that's just some of our personal investing. But we do some short-term, but mainly long-term residential assets, single family, small multifamily across the country. This is our core turnkey build to rent company, rent to retirement. When we enter a market, Rodman, we want to look at areas that there's basic fundamentals, but then there's also things that are specific to that geographic area. But fundamentally, we want to be in areas where you have landlord-friendly legislation, areas where you can actually operate your business and not have a tenant stay in your property for a year without being able to evict them, things like that. We want to be conscious of the tax structure, both property taxes and income taxes in those states. Supply and demand is by far and away the most important thing. And I think when you're starting to analyze areas, just look at supply and demand. We already talked about there's a huge undersupply of housing, and there's a huge population shift, a lot down to the Sun Belt, some of those markets we talked about. So we want to be in areas where there's an undersupply of housing and the population is growing. There's a huge demand. We look at a diversity of industries. We don't want to look at an area that's just, say, reliant on oil or gas or government, because that could change over time. So we want to see a diversity of industries. We want to be in houses that are below the median house price point. So median house price point in the U.S. right now is teetering right around $400K. So we want to be in areas where we can put up a brand new construction A-class asset between $200,000 to $300,000, because that's going to have the largest demographic for renters and resale buyers when it comes time to sell those properties. And there's less fluctuation at those lower price points. There's more affordability, and we're also helping to solve some of those affordability issues. So I mean, those are the things we look at the market on the macro scale. We also want to look at where is transportation being developed, and of course new job growth in these areas. And we want to focus on some of the up and coming neighborhoods. Like all builders are trying to build in areas where there's, demand for housing, and we want to be conscious of those as well. I think it would help to clarify this too, just for people that are trying to understand, like, well, what is turnkey and what do you guys actually do? Our company does two things. So we work in about 18 different markets. This is Midwest and Southeast, where when we talk about turnkey, basically what we do is we either rehab or build new houses. About 70% of what we do is new construction. So we mainly focus on new construction houses in markets that fit all of these criteria that we've identified opportunity. We built our teams and systems in these areas to offer consistent investment products. But we talk about a turnkey property. It's a newly built house that's leased and managed by our team in that area. So you have the benefit of investing in these areas where we've done the market research, we've already set up the team, and you have the ability to diversify your portfolio easily in these areas without having to buy yourself another job as a property manager. And we do two things mainly on the build to rent side. one, we're builders and we build houses, but that's only about 10% of what we do. The second thing that we do is we actually form partnerships with national and regional builders in these areas. These are renowned builders like Toll Brothers, Lennar, D.R. Horton, LGI, where they produce very quality products. And we can go to them and actually work with their wholesale division, not their retail division, their wholesale division, because as a community, we're buying hundreds of houses every year, just like an institutional buyer like Blackstone would do. And we're able to come in and negotiate wholesale type of pricing that we pass on to our individual investor. And so what that means is that you get access to deals that you wouldn't get access to on your own below market value on a $300,000 property that may be producing, whatever, 12% cash on cash return. You could actually buy that potentially, say, up to 10% below market value. So you're buying it with immediate equity. And so that's I just wanted to add some clarity as well. Not only are we entering the markets that we see opportunity, we're also providing opportunity on the buying structure where you can be a strategic investor to acquire assets, well below market value. It's still a brand new construction A-class asset that will be positive cash flow and will handle everything for you. But hopefully I just wanted to give some clarity on when we enter a market, what we do.
No, that's great. It's good to understand the business model too, because, like you, I've invested for many years and I've got so many people that have always come to me and say, hey, I see what you're doing. I want to be a part, or I want to learn how to do this, or I want to understand. But it's nice that somebody can come to you and it's plug and play. I mean, really, if you want to get into the market, you want to get into an asset, and how great is it to be able to come in and get immediate equity? I mean, that's huge if you can stick that on your balance sheet right out of the gates. When you're coming into a new property or a new opportunity. I want to touch a little bit about the tax structures and the different tax benefits that are available out there. I know you talked about 1031 exchanges a little bit earlier. What would you tell people who are in here who don't really understand what a 1031 is, or how to optimize a 1031 to make sure that they're maximizing their returns? Can you give them a little bit of an idea of what that looks like?
Yeah, and this is something, Robin, you got to feel free to cut me off at any point, because I'll get on my soapbox and we could talk taxes all day. But this has been, as we've become more sophisticated investors and been able to, as we've earned more money, it's obviously we've been more conscious about the taxes we've been paying. But also we've learned over time that real estate is the most tax efficient investment you can make, hands down. There's nothing that compares. So being able to use the tax benefits as well as using leverage in real estate, I mean, you can accomplish a significant amount of progress and create a lot of wealth within a shorter period of time, just being conscious to those two things. But when someone on the surface is just what are the general tax benefits of real estate? There are a ton, but the most impactful ones I really break down to three core things right now, 1031 being one of them. And so to answer your question, being able to 1031 exchange your property is essentially where, instead of paying capital gains on your investment, and this is any investment, right? This is your stocks. This is a real estate property. You buy property, today, 200K, it's worth 300K in 5-10 years, whatever the case is. You have $100,000 potentially of capital gains that you would pay if you sold that asset. Mm-hmm. Well, essentially what the IRS allows you to do is to roll that in there's timelines. You got to identify a property in 45 days, close in 180, but you can identify other real estate assets and move that money into those assets without paying any capital gains. So that's dramatic, right? Because not only are you able to defer your capital gains, but you're able to actually buy more real estate, which has additional tax benefits. And you can perpetually defer capital gains forever and never have to pay that. If, say, you pass off your portfolio to your children, they get what's called step-up basis. I'm not a CPA or attorney, but we have very good ones. And you're able to really just, have more money today to be able to scale your portfolio. The two other things that are really impactful, I think, are worth mentioning. One is, a lot of times people don't really understand, your income from your property, if you're using leverage and structuring it appropriately, really should be tax-free, or the majority of it should be tax-free. That's why we call it tax-free income, and that's very powerful as you start to build a larger portfolio. But if you had, say, $100,000 annually of income from your properties, if you're using leverage, take all your write-offs and depreciation, all these things, really there should be very little to no taxes due on that $100,000. That means that's the equivalent of, depending on which state you live in, possibly $150,000, $160,000, $170,000 of earned income, because it's actually net. That's extremely powerful. And the third thing, and probably the most impactful thing, which is still relevant today, is taking accelerated depreciation. And for all the short-term rental investors out there, especially the ones that are actively managing their properties or participating in that can qualify as real estate professional or don't need to because of the short-term loophole. I mean, take an accelerated depreciation where you take a good portion of that depreciation in year one against all income sources. I mean, that's just a game changer because we have a successful business. Our goal every single year is to buy enough real estate to successfully write off all of our income and from all sources. And that's, a lot of money that we'd otherwise give to Uncle Sam that then we have to reinvest into more assets, again, that have more cash flow, that have more tax benefits, and you get this snowball effect. And that's how you can create huge amounts of wealth within, a short period of time. So those are like the big tax things. If you were to focus on just a few of like, what are really people doing to create generational wealth? I think it's a combination of those things.
Yeah. And you had mentioned about accelerating the depreciation, and you're talking about cost seg, right? In those situations, doing a cost segregation study and being able to look at each component of the building and then write those off in a kind of an advanced model of depreciation, correct?
Yeah. And just to use a numeric example, like if you bought a property that's worth $1 million, and not to get too technical, you do remove land from this, but let's say $1 million worth of improvement value on the house, buy a property for $1 million. A lot of our studies come in usually between 34 to 42, 43% of accelerated depreciation. But on that $1 million, you would take $1 million worth of depreciation on residential property over 27 and a half years, with doing a accelerated depreciation with cost segregation. What you're doing is like carving out a portion of that to take in year one. And the idea, and anyone can do that, but where it gets really exciting is being able to offset your active income from your W-2, from all these other sources, which you can accomplish doing short-term rentals and actively managing those, or being a real estate professional, which is the same thing that we do. But on $1 million worth of real estate, if you had, 30, let's say just for conservative numbers, say 30% of that's $300,000 at 100% bonus depreciation. Now we're at 60% this year. So you take 60% of the 30%. So 60% of 300K is 180K. So you buy $1 million worth of real estate, you could, in theory, get a $180,000 tax write-off this year from doing that, right? And if you think about this a little bit further, if you buy $1 million worth of real estate at 20% down, you can buy, that's $200,000. So you could leverage $200,000 to get $180,000 of tax deduction. And I'll go one more step with this, Rodman, because we have conventional lender, we have portfolio lenders, local credit unions, and most markets that we work in where they'll offer true investor loans with as little as 5% down. These are on true investment properties. You don't have to live in the property. This is a portfolio loan. So these are some of the strategies we help people employ, where like you can buy a property with 5% down and get this huge tax break if that's what you're going for, but still you're stretching your capital further. So being conscious of all these things, really dramatically impactful.
You're talking my love language. I mean, like literally, I'm smiling on the inside and the outside when we're talking on these things, because I think a lot of people don't understand how many benefits there truly are. And, if you think about wealth building itself, I mean, there's no greater vehicle to build wealth than real estate, especially long-term generational wealth. And unfortunately, a lot of people don't think they have the access to it. I don't have the money. I don't have I'm not able to go and buy these investments. But like you said, there are vehicles out there like these portfolio loans where you come to the table with 5%, 5% out of the gates. And okay, so maybe people say, well, I still can't even do 5%. Okay, well, then maybe we've got some work to do. Maybe you're gonna have to get creative, or maybe you're gonna have to figure something out. But it's very available to people if they just know what the right resources are, or can connect with the people that understand how to get them into financing vehicles that are going to work for them.
Yeah, 100%. It's just being educated, right? And if you don't know what you don't know. And so I think it's really important to surround yourself with like-minded people and, just constantly be figuring out ways that you can be a strategic investor to maybe follow a path like I did and try to buy property every single year. You don't need home runs. Don't quit looking for the home run deal. Do be analytical. Don't arbitrarily buy property. But if you can consistently buy property over time, that's, like you said, Raman, this is a guaranteed path to wealth and financial independence. And if you do it long enough, generational wealth, maximizing the tax benefits, being a strategic investor, diversifying across the different parts of the country, utilizing creative loan structures like we talked about with possibly 5% down. It's all these things are little levers that you can pull. But really, at the end of the day, it's about owning good assets in good markets with good teams and doing that consistently over time, because time is your biggest friend when you own real estate, just letting real estate do what it does.
Do you have a favorite asset class? I know you've got multiple asset classes. What's your
This
favorite?
isn't just because I'm talking to you and your audience. I know a lot of big short-term rental investors, but man, and I've only been investing in short-term rentals for probably the past 5 years. Um, Before then, I was really like, I started with house hacking, and we did flipping and wholesaling and all the things to build capital, and I invest in residential, and I still own, I think residential real estate, and I'm talking about long-term, like your bread and butter housing. I think that's the most resilient, predictable asset class. And so we'll always hold a portfolio in a good portion of just residential, right? In good parts of the country. Like those are your bread and butter rental properties, your little oil wells kicking out good cash flow that appreciate. Um, and we own commercial retail. We've done industrial. But I would still say today, I'm really excited about short-term rentals because we talk about not being emotional, but short-term rentals, I mean, that is a benefit to those is not only can you do some extra stuff on the tax side, but that's the fun real estate to talk about. No one wants to hear about my retail centers and the problems I'm having with my tenants and boo-hoo, right? But the short-term rentals, those are just like, that's where real estate gets fun. Those are lifestyle assets where you can use them from time to time, and that's like actually tangible and fun to talk about and to see. And so I think personally, those assets I have a lot of fun with. They are frustrating sometimes, like on the regulation side, you have to get through that stuff. But I would call that the fun real estate.
Yeah. Well, and there's a big difference between, say, an office building where you get people to come in and they lease for 5 years, and maybe you talk to them once a year to make sure, check in, things are okay. But I mean, it's truly a business on the short-term vacation rental side. People go, well, why, I could go buy this asset over here, this office building at a 7 cap or a 6.5 cap, whatever it might be trading on. But they go, well, so I'll just get a short-term vacation rental, same thing, 6, 7 cap. And I was going, no, 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 no. It's a very different asset. I mean, you want to make sure that you work in the brain damage that you're going to have because there's so many more moving parts during the year. It's more like a business. You should have at least, for us, my minimum barrier is an 11 cap, cash on cash. If I'm doing my pro forma and estimating out everything, if it doesn't hop over an 11% barrier, we say no. We walk away from it right out of the gates. So people got to understand the difference in asset classes that come with risk, with brain damage, with the amount of work, and factor those things into the cap rates. And unfortunately, a lot of people don't. They don't even know how to get to the cap rate. Most of the time they look at it and go, it's a vacation property. I'm just going to see how much money I can get in. And they don't understand, well, maybe I should have put away for reserves. I wasn't thinking about maybe like we just have a property in Costa Rica. We had to put in 100-foot long by 13-foot tall retaining wall because of a river decided to kind of move, right? But luckily that's all factored in. We go, okay, how much money do we need to put aside for reserves and such in case we have an issue that comes up? But people aren't going through a lot of those scenarios when they're buying vacation homes.
Short-term rentals just have more variability. They just do, right? Because you can have fluctuations in occupancy. It's not like it's more involved, especially if you're self-managing. There's a lot of variability, and you always need to be paying attention to competition as well, right? That's the other thing is like what's happening in the market, what's changing. Is there new development, new properties, new owners? Is there new amenities to the area? There's all sorts of competition that you need to. So it is an active business. That's why the IRS considers it an active business, because it very much is, and paying attention to those things are important. And it can require a lot of work. Now I have property managers on all my properties. That's a tough thing for people to do because sometimes property managers, they charge a lot, right? And you also need to factor that aspect in. But I've kind of formed a unique partnership where you're truly partners on some of these deals, right? And so there's that more integrated role, but you can also make short-term rentals somewhat passive. Maybe that's not the first place to start, but over time, same like any business, you build systems in place, and it can be, and put the right people, partner with the right people, hire the right people. You can create it so it doesn't have to be a fully active scenario as well.
Yeah, but a lot of people underestimate how active they are going to have to be when they've made that purchase. They come in, they don't understand how important it is to respond to an Airbnb request for information or
right away,
or a
right?
question. They're not thinking through this, okay, this day-to-day stuff that I'm going to have to be doing all the time. And unfortunately, by underestimating that, again, they get to the point where they go, well, maybe I should just have somebody manage this. And then they go out to manage. And the other mistake they make then is not really truly understanding how much it's going to cost for the management. Then they see all their profits erode because they're paying this management fee that they weren't expecting. And I always tell people, it's like, work in the management fee right out of the gates with your pro forma. Work it out. Work out a third-party management fee, and then see where you're penciling out at the end of the day in terms of returns. And then if you decide you want to do it yourself, okay, think of that as almost salary to yourself for all the things that you're going to have to be doing to handle the property. And if you don't want to do it, then you still are going to get a good return if you've done your pro formas right and bought the property.
Yeah, I love that. I love that, considering it like a salary for, because yes, it is very active. It is very involved. There's going to be a learning curve with it. And when people do, hire managers, sometimes they also cheap out and try to go with the national ones that maybe have lower fees, but like that may not be the best solution for you, but I do agree, like self-managing to start, just so you have the understanding and the knowledge, I think is a really good thing to do. And then that will help you potentially be a better, hire when it comes time to looking at different property management companies. And I'm interested to hear your opinion too, Rodman, but we found, like, when you're bringing a new short-term rental to the market that maybe doesn't historically have short-term rental data, or it hasn't operated short-term rental, your first year is not going to be your optimal year, right? I mean, sometimes it takes us multiple years to get to kind of that optimal performance, where it's like you have repeat guests, you have visibility, you have lots of 5-star reviews, you have all the things, you have, in the algorithms with the listing sites, like you're getting more visibility and those things. Like that doesn't happen out of the gates. And so,
no, well, people buy a property like that, and they think that they're going to acquire somebody else's rating, their Airbnb rating. And when you go into these properties, you don't have that. So if somebody's got a 5-star rating and they're a super host, it doesn't mean all of a sudden you're going to come in and be a super host with a 5-star rating. That goes with the person who owns the property. So you might have to take the first 6 months just to rebuild all the ratings. You need to get that visibility to get into the algorithms with Airbnb. And so you're right, that first year is kind of like, you really need to go in and work on stabilizing it, getting it up to where it's going to be performing at an optimal rate. And it takes time. It's not something you just overnight get into and start doing exceptionally well.
Yeah, couldn't agree more. But it is a fun asset class. Even though it takes a lot of work, it is fun those are the real estate assets that are fun to talk about, that people have interest in and that are fun to see and stay at potentially. So that's where real estate gets a little bit more fun.
Well, I'm impressed that you're doing well in the Summit County market, because I know Summit County very well, and you're going outside of the box, which is probably why you're outperforming and doing well, instead of getting that lower end where there's so much up there. I mean, it's a great ski area, so it's very attractive. So many people have rentals up there, but to get outside of the competition, you've kind of just done something differently up there, correct?
Yeah, it's different assets. So we specifically buy stuff that's a 6-bedroom and above. We look for in-suite bathrooms, and we obviously want to be focusing on areas we can still do short-term rentals. I mean, like Breckenridge, for example, they have Resort Zone 1, which is now like basically Main Street or ski and ski out luxury homes. Nothing else can get a new license for short-term rental. Keystone's a little bit behind the time, but they're also just now, as we're talking, redoing how they're evaluating the short-term rental. So, I mean, being conscious about regulation has also been a little bit of a feat. But yeah, we focus on higher end houses where you can have their multi-generational homes. We have amenity services as part of our managerial offering, where we have shuttle services from the airport, large buses or large shuttle buses. We'll have, we have chef availability to come in, masseuses, transportation to the ski resort, rentals available at your door for skiing. And so these are some of the things that just like we're catering to a higher category or demographic, I would say, that is looking to bring a large family in for a period of time and wants the convenience factor. So that's who we're kind of focusing on. But higher end homes where there's not a ton of them actually that can accommodate that many people simply. And because of that, we've been able to be a little bit more unique in the type of things that we do and not, stand out a little bit more than the competition.
I want for people to be able to find you. It seems like you're a wealth of information. And, for me, it's kind of like, I want people to be professional in this space. For all of us, we all benefit when everybody's got a level of expertise, a level of knowledge that is exceptional. So where do people need to go to find you?
We always want to drive people, Rodman, to our website. That's renttoretirement.com, renttoretirement.com. We have our own robust podcast and YouTube channel. We put out a lot of information just about market data. So, if you're interested in learning how to invest in different parts of the country, if you're interested in, turnkey or just some of the loan structures I talked about, putting 5% down or just market data, all that is publicly available. That's on our website. And if you're listening to this audio, you can text REI to 33777 and get set up with our team to just learn more about, investing and growing your portfolio.
No, I love that. And I love your story too, because so many people come into this the same way. I mean, they don't get up one morning and go, I'm going to be a real estate investor. They're doing other things, and then they find real estate, and then they get fascinated by it. Then they can see the potential behind it. But there's so many people that are coming into this space that we want to really be able to help evolve exponentially, to get better, to get smarter, to get wiser, to help reduce their risk as they're coming in, to maximize what they're doing. But if you could go back to yourself when you were first coming in, what would be one piece of advice that you would feel to be very valuable for a new investor coming into this space?
Everyone can go back and say, I wish I would have started earlier and been more aggressive. So I'm not going to say that. I think the big thing for me, I'm one of these guys that's like a ready, fire, aim. Like I learn on the go, and that served me well sometimes, also burned me sometimes. But I think I would have been more open to investing outside of my backyard earlier, because we did miss the bus on some markets just because we were scared. We were watching those markets before we decided to take the plunge into them. And it's like, obviously in hindsight, we wish we would have participated earlier in those markets. But yeah, and I think that's true about a lot of different asset classes and investing, like, being open-minded about what the future can be, and not being so scared. I mean, you don't want to arbitrarily buy something without knowing the numbers and really being an analytical minded person. But, we all get the analysis paralysis, right? That happens. We get the shiny object syndrome where we're looking at 1,000 different things. And so I would say that focusing, just my advice and final here, is to be hyper focused on one asset class, one investment, and, succeed at that. And then, look at what's next, and be open-minded as well to possibly investing outside of your own backyard, because that is probably the single most impactful thing that changed the trajectory of our lives and our business, is when we started investing in different areas outside of our own local area.
No, I love that. Get started, take that first step, get smart, get good. And, it's one of the best ways to build wealth in America is real estate. And if you're not in it, you need to get started. You need to get good, and you need to really go out there and start just doing it. So thanks for coming on today, Zach. I really appreciate it. And you and I'm going to have to hit you up. I'd love to pick your brain a little bit more as a fellow investor on what you're doing up in Summit County. But thank you for coming on the show today.
It's been a pleasure. Thanks so much, Rodman.
Thank you for tuning in to this episode of the Vacation Property Secrets Podcast. If you enjoyed the show, we'd really appreciate it if you could leave a rating and a review on Apple Podcasts or Spotify. By leaving a review, you not only support the show, but you also help others find and enjoy it just like you did. Also, please share this episode with somebody who could benefit from it. And if you're aiming to build a short-term vacation rental investment business that's based on strong investment fundamentals and not just emotion, I'd love to invite you to a free training that I'm hosting. It's my financial forecasting for maximum vacation home profitability training, an on-demand video course that's completely free. It walks you through the investment fundamentals to build and scale your short-term vacation rental business. You'll also learn how to estimate investment income and your operating expenses to build a projected pro forma operating statement and the potential NOI and return on investment for your property. Just go to vacationpropertysecrets.com to get access to your free training. We'll see you next week for another episode of the Vacation Property Secrets Podcast.